Hello, Ed Yardeni here. Glad you all could join me today. Over here, we've got some sunny weather, but it's cold, so we haven't quite gotten to the spring weather, but it's coming. So I hope you're all doing well. I know there's around the country there's been some pretty inclement weather, to say the least. Yet, as it turns out, February might have actually been. I don't know if it's as moderate as January, but it seems to have been. Why all this talk about the weather? Well, it apparently affected the January indicators. We had a very mild January weather-wise, and that is widely believed to have contributed to some of the strength in the economic indicators that came out for January and February. As you know, we had a great January and February, not so great. Because suddenly the markets were focusing not just on the soft versus hard landing scenario, but now all of a sudden there was a no landing scenario. And the two variations of that, which is, of course, the inflationary no landing, which is probably the worst possible case because an inflationary no landing scenario will inevitably force the Fed to just kind of give up on trying to find that nirvana path of enlightenment where the economy grows and inflation comes down, and the Fed is just restrictive enough to do that. Now the concern is that if we have the inflationary no landing scenario, that is just a long way to a hard landing, because the Fed may very well conclude that the only way to bring inflation down is with a recession. And so let's let it rip. Let's let interest rates go to 6%. The Fed funds rate, hopefully it doesn't need to go any higher than that in this particular scenario. But the market will obviously not do well if suddenly we're talking about a 6 handle on the Fed funds rate and maybe a 5 handle on the bond yield. I still think that's a 20% probability scenario. An alternative is a disinflationary no landing. After all, inflation has been coming down. Certainly has been coming down for consumer durables, and even food and energy prices on a year-over-year basis are showing some disinflation. It's the services that's a pain, and we know that rent inflation is going to come down. It's just the Fed has become very much of a stickler, obsessed with services excluding housing. Things like mundane things like grooming a pet, going to the vet, things like insurance for your auto, and transportation services have been really hot. So they're focusing on that, and their concern is that that's very much tied to wages, and they're concerned that the labor market is too strong. And so their goal is to slow things down in the labor market, push up the unemployment rate just enough to take the pressure off of wages. And again, they may give up on that notion if the economic indicators over the next 2 weeks are too strong. Again, the weather's a factor here. So to the extent that February was also unseasonably mild, that may mean that we've got another batch of strong economic indicators just in front of the FOMC, the next FOMC meeting. I'm still in the soft landing camp slash disinflationary no landing camp. And I still think that we probably saw the peak in the bond yield at 4.25%. Obviously, we're getting close to that. And I think that we got two more rate hikes. But obviously, I'm thinking that this next batch of economic indicators may show moderation relative to what we had in January. So that's where I'm coming from. Let's look at some of the data that is relevant to sorting all this out. So let's go over here. This is the website, and just wanted to start out on the website in the U.S. economy section. There's something called economic calendar, and where is it? There it is. We update that every single month, obviously, and you might be interested in using this as a resource tool, because what we did is we made links to our charts on the calendar. We call it a live economic calendar. So you can start using it this week if you haven't used it before. We're going to get consumer credit tomorrow. I don't think it'll have much of an impact on the market one way or the other, but there you'll see an automatically updated bunch of charts on consumer credit. The big number on Wednesday is going to be JOLTS, and we have a bunch of charts on JOLTS. Let me just show you one of them that I think is particularly interesting, and I've done this recently, so I piled them on in the back. And what just shows is that this is among Fed Chair Powell's favorite indicators for the labor market. He's looking at job openings, and as you can see, it jolted to the upside in December. And it's actually a laggard in terms of when it's reported, because we have data on jobs plentiful from the Conference Board survey of consumer confidence. And we also have the NFIB's series on small businesses with job openings. And so the green line is the jobs plentiful, and you can see that that's actually gotten higher in February, and in January, the small businesses with job openings rose. So it's quite likely that the January number for JOLTS will be up, and the market may sell off on that, may be concerned that this demonstrates once again that the labor market is red hot. So JOLTS, I think, will be important. We know the mortgage applications are continuing to take a dive. They rebounded a little bit in January when mortgage rates came down, but now with this latest backup in interest rates, bond yields, mortgage rates, odds are this mortgage applications indicator will continue to go down. And if you're just curious, you can just go to the publication and you can see that mortgage applications soared during this period. Somebody told me that something like 70% of outstanding mortgages were made since 2020. And that just didn't sound right to me until I figured out that a lot of them were refinanced. So it's true that refinanced and new mortgages may very well account for 70% of mortgages outstanding, which means that a lot of people bought houses or else refinanced their mortgages at interest rates or record lows. And that may be another reason why we're not seeing a supply of housing, is that anybody sitting on a 3-4% mortgage rate isn't going to be inclined to even trade down for a house. Let's say they're retired people, given that they'd have to finance that at 7 to 8%. But you can see this is heading back down again. We're in a rolling recession, and the housing sector is in a recession. Let's see what other goodies we have here on the calendar. And then, of course, the biggie is going to be the employment report on for February. And again, you can click there and see the charts. They will be updated within a minute or two of when that release comes out. Meanwhile, let's go to the charts, which is what we typically do. And I guess I was looking at them. So these are the March 6th, that's today. And you can see some of the analysis of that morning briefing. This is, we had data come out on productivity and unit labor costs, and the market kind of looks at these things, but I think it's complicated enough with enough data points that the market doesn't pay a lot of attention to it. But actually, the most all-encompassing measure of compensation, labor compensation, is unit labor costs. It includes proprietors, for example. It includes family members who work and don't get paid, but I guess as long as the company's doing well, they're going to be doing well. So there's a lot more comprehensive measure than the employment cost index or average hourly earnings and some of the other measures. And you can also see that when you take the year-over-year percent change in unit labor costs, which is hourly compensation. Hourly compensation is really what I meant when I said that it's the most comprehensive measure of compensation. So unit labor costs are equal to hourly compensation divided by productivity, and it's a pretty volatile series, even on a year-over-year basis, which tends to smooth it out a little bit. But on the other hand, you can really see that it's certainly highly correlated with the headline CPI, or the other way is the headline CPI is probably driven to a large extent by what's going on with the unit labor costs. But the causality is both ways, because we know that when price inflation is going up, it puts upward pressure on wage inflation. So it's not as though the causality is one way when you look at this chart. But you can see, if you take a magnifying glass, that maybe, just maybe, we had unit labor costs peak during the third quarter of last year. It came down a little bit, and we'll see how that plays out up ahead here. I think that when we look at unit labor costs, we're looking at two variables: hourly compensation and productivity, as I said. Productivity has been really messed up by the post-pandemic labor market. People have been quitting left and right. So here's the 12-month sum of quits, basically at an all-time high of, get this, 50.5 million people quit last year in the 12 months through December. And when you take that and divide that in payroll employment, really a third of the labor force just quit. You know, take this job and find somebody else to do it. That can't be good for productivity. So we're hopeful that as the labor market kind of simmers down, that we'll see quits moderating. And we'll see in a minute, there's actually a decent correlation between quits and wage inflation. In other words, when quits are high, people feel like they can move to another job and get more pay. When quits are low, they have a different sense of the labor market, that maybe it's not as tight and there aren't as many jobs available for them to make more money. It's a traumatic thing to leave a job after you've been doing it for a while. And so you really have to believe that you're going to get a better job with better pay to quit. And apparently a lot of people have been thinking that. So if you got all these quits, you got lots of hires, and the hires have been 76.4 million, a lot of churn. And that is 50% of the labor force, just to put it into some context. Again, a tremendous amount of churn in the labor market. Job openings, as we know, we've got basically 2 job openings for every unemployed person. And this is what Fed Chair Powell would like to see come down. Instead, it's going up. But at the end of the day, of course, it's the CPI, it's the consumption deflator, it's wage inflation, it's the actual inflation numbers that'll drive Fed policy. Powell, in a November speech last year, it came up with a kind of clever chart here showing the labor force as the supply of labor, and the demand for labor as the number of people employed plus the number of job openings. And he actually had the data concocted prior to this, but you had to do some finagling to get the back data. But the actual data that's available starts in 2001, and you can see that the supply of labor exceeded the demand for labor during this period here. Then 2018, 19, things started to get tight in the labor market again. And then everything went haywire during the pandemic. And since then, we've got a labor shortage. And that's just another way to look at it: demand minus supply of labor. So let's go back to this productivity, hourly compensation, unit labor costs. Let me take my touch screen and touch it and show you that, you know, the productivity story was really, really ugly when you looked at the, well, it's ugly if you look at the year-over-year percent change. It's down 1.8%, which is the worst full year of productivity since 1974, which is, you know, when the economy was really having a pretty weak productivity problem. So that's unsettling. Then again, the first couple of quarters of last year is where you had these big drops in productivity, and then things seem to have improved, slight uptick in the third quarter, and then we've got 1.7% at an annual rate during the fourth quarter. Obviously, this isn't enough to make any sort of conclusion, but what I do for a living is I forecast, and I'm forecasting that productivity is going to improve, that the improvement we saw in the last two quarters of last year will continue this year, maybe around 2.5% this year. And I think it's on its way to 3 to 4%, but that's the roaring 2020 scenario, which clearly hasn't worked out so far. So far, it's been more like the great inflation of the 1970s, but it's been the great inflation of the 1970s and steroids and speed. I mean, things are happening so quickly here, and I think we are going to continue to see disinflation as the year progresses, even in services, particularly rents. And I do think that productivity will make a comeback as the businesses come to conclude that, you know, just coming into the office and figuring out what your cost did yesterday and how to pass it on today, it's not really business. It's just it's just being part of the wage price spiral. I think companies are going to realize that the problems they're having in the labor market are chronic. They're not going to go away. It's a problem that needs to be solved, and technology always seems to be able to come up with ways to solve this thing. I kind of doubt we're all going to be replaced with artificial intelligence tomorrow, but you get a kind of a glimpse of what may very well be ahead in terms of using technology to at least augment labor, not necessarily replace it. Hourly compensation also is a volatile series. On a year-over-year basis, not so volatile. It was around 4.4%. I think the Fed wants to get compensation inflation down to 3%. I think their assumption is that productivity can grow steadily around 1%, which isn't much. And if wages grow 3%, then you get increases in real wages without increases in without more than a 2% inflation rate. I think that's what they're shooting for. Easier said than done on a short-term basis, but I think it's achievable by 2025, which is, I think, when they're trying to get back down to that 2% inflation target. Meanwhile, on a quarter-over-quarter basis, it's still high at 4.9% for the hourly compensation number. So unit labor costs, when you look at it on a year-over-year basis, still high, 6.3%. When you look at it quarter to quarter, there is sort of a moderating trend here in unit labor costs. So that gives me some hope here that the year-over-year is going to simmer down, and therefore the year-over-year and the CPI and the consumption deflator will do the same. Let's just quickly revisit the roaring 2020 scenario. Here you have a chart of productivity growth on a 5-year basis at an annual rate. Same thing for the civilian labor force. And you can see that coming out of the 50s, going into the 60s, we had a big surge in the growth rate of the labor force because of the entrance of baby boom men and women into the labor force. And so we're looking at something like a 2.5% growth rate in the labor force. Then they all entered the labor force and things started to slow down. And now we got down to zero. We had some improvement here. Now we're back down to, well, on a 5-year basis, we're only down. We're only at 0.6%, and short of immigration, which is a relevant issue here. But short of that, the underlying demographics of our population growth for working age population suggests that this is going to continue to be an issue here in terms of the availability of labor. And I think that means that companies are going to have no choice but to figure out ways to increase their productivity. And so here's the productivity of the 1950s. That was the productivity boom back then, and then it kind of fizzled out. The productivity boom of the mid-60s fizzled out. Remember, these are 5-year averages. So at this point, we're talking about 4.5% over the past 5 years is the kind of growth rate we had in productivity. Quite remarkable. But then it all kind of fell apart for various reasons. The great inflation was exacerbated by the drop in productivity down to virtually zero. Then we had a mini Reagan rally in productivity. We had a high-tech revolution productivity boom over here that kind of faded out. I mean, back here, you still had the clunky cell phones. We had these desktop machines that could do Excel and Word, and they were pretty good if you were replacing a lot of selector typewriters or helping accountants do their jobs more quickly. But that was about the extent of what they could do. But now, since then, I think we're now in a new technological revolution or second phase where technology that's available now is applicable to every business. and that in a sense, every business has to be a technology company, has to use technology in order to increase their productivity. And I think we were on the way there. As you can see here, we went from 0.6% 5-year productivity annualized growth to something's missing here, scale, to something like 2% productivity growth. Then the pandemic hit. I think this thing's going to go back up to 3 to 4% in a roaring 2020 scenario. I got 7 years left to see if it happens, and 7 years to say I told you so, or 7 years to say, well, here's why it didn't work out. A couple of quick ones here now. This is the employment cost index, which is, I think, the Fed's favorite measure for wages and salaries, and that's available quarterly. And I compare that to the Atlanta Fed's median wage growth tracker, and they both look kind of like they're peaking. But obviously, what we want to see for the Fed to be happy, for us to be happy, for life to be good, we want to see these things coming down rather sharply in coming quarters. This is the employment cost index versus average hourly earnings, another measure. These are wage measures, also kind of looking peakish. I mean, it doesn't look as bad as it did back in the 70s, certainly. What else? Employment cost index, again, versus non-farm business hourly compensation. So we've been spending most of our time here focusing on hourly compensation as one of the measures that are released along with productivity. And here you can see just how volatile this hourly compensation measure is year over year versus the employment cost index. Hard to say much of anything here, but given my optimistic bias on things, I'm seeing a peak. Meanwhile, if you just take wages and use average hourly earnings data, which comes out with employment, divide that by the consumption deflator, and you can see that since 1995, it's been rising at a 1.2% annualized growth rate, which is pretty good. It compounds nicely into, I think when you go from here and compound it 1.2%, you get a 25% increase in purchasing power or the standard of living. We stalled out here during the pandemic. Now I think we may be seeing that going back up again. That's only going to happen if productivity is improving. So I'm going to use that as a sort of a monthly indicator of whether I'm right or wrong on the productivity trend improving. Here I mentioned before the ECI wages and salaries. You can see that relative to the quits rate, pushed ahead by 9 months. So it's pretty good. I mean, it suggests that things are going to get better on moderating wage and salaries as assuming the quit rate continues to fall, which clearly is what I'm thinking. And we'll have a reading of that with the JOLTS report on Wednesday. We can skip that. You can look at it on your own. Yeah, I think we pretty much covered it. Let's go to the Q&A. Let me take a little swig here. So, Anonymous, what are your thoughts on zero DTE options expirations driving current market price level? I'm really not well enough informed about it. I'm not an options expert. It may be one of the contributors to the rally, but I think this rally started on October 12th, and it hasn't been all related to these option expirations. Kevin, it looks like these mini recessions have an impact on volatility of equity markets. The path for SPX prices looks volatile, as we saw on Friday's reversal. Do you see this continuing throughout this year? I see it continuing for the next few weeks. Nothing seems to last for very long in terms of what the market does. Sometimes you get extraordinary volatility after a few months, followed by calm, and everybody figuring that we can relax, and then volatility makes a comeback. It's a volatile world. There's always something going on. Also, with instant communications, I can communicate with you now with QuickTakes. Within 5-10 minutes, we can generate. Here's what we're thinking about this or that, and of course with video technology. But my go-to guy in terms of short-term trading notions of what the market can do is Joe Feshbach. We've been quoting him regularly, and I think he's been quite good, very good. Otherwise, I wouldn't be quoting him. And his view is that we need to see more bearishness build up here in the market, that he doesn't like it when there's too much greed on a short-term trading basis. So his feeling is that the market is still in the trading range for now. My feeling is that from a fundamental perspective, no recession. If it turns out to be a disinflationary no landing, if it turns out to be a soft landing, I think that's what the market is still getting excited about, has been getting excited about since October 12th. And it's not, I don't describe them as mini recessions, I describe them as rolling recessions. I mean, housing is experiencing a pretty severe recession. The semiconductor industry is experiencing a pretty severe recession. Goods producers have been swamped with excess inventories. You know, there are a lot of sectors that are experiencing full-fledged recessions. It just isn't adding up to an economy-wide recession. It's not all happening at the same time. And the key development, I think, is we have yet to see a credit crunch. It's when you get a financial crisis that kind of turns all the financial intermediaries into very cautious lenders, even to good borrowers, that you get the credit crunch, and that's what causes recessions. Okay, KB, if the Fed moves to 5.25% and pauses and you don't see a recession happening, what happens to the inverted yield curve? Assuming the inversion is signaling a recession, when does the curve adjust to a non-recession form, and how does it change? Yeah, the yield curve has been one of my favorite topics. It's an interesting one, certainly. We have an inverted yield curve. In the past, inverted yield curves occurred before recessions. But there are only 11 observations on this, and people think you can run a regression and get a high, you know, R squared and T squareds on the coefficients. For those of you who remember, painfully remember your econometrics, 11 times that this has occurred doesn't necessarily mean that it's inevitable that it occurs again, namely that an inverted yield curve unambiguously calls a recession. I could be wrong about that, but I think what's missing here is that credit crunch. I think what the yield curve is predicting is people are buying bonds because they figure that even though they can get more return in the short term, they're not convinced that on a 10-year basis, when they buy a 10-year treasury note, because they have that kind of investment horizon, that they're going to continue to get those higher yields, you know, renewing on a 3 months, 6 months, 1 year basis. And that implies that they think that there's going to be a recession, or that implies that they think there's going to be lower inflation. It implies they don't think the Fed's going to go a lot higher. When you look at the inverted yield curve, it happens to be, when it inverts, it's pretty close to the end of the monetary policy tightening. And again, just because it's happened for the past 11 times doesn't mean that, you know, it's foolproof. But I am using it to support the idea that the bond yield peaked at 4.25% on October 24th, and that the Fed's got a couple more tightening of 25 each, and that may be it. But I could be wrong, and I guess may not have to wait very long here, depending on what the next streak of data shows over the next 2 weeks. You know, my bottom line is things aren't terrible. We're not having a recession. Inflation's coming down. It may take a couple more years to get it down to 2% or 2.5%, something the Fed can live with and talk about trying to get it down to 2. But you know, there's been way too much pessimism, but maybe we're about to see another round of it. Arnold, sorry, Brian, we've spent nearly a full year with an inverted 2-year, 10-year yield curve, and at minus 90 bips is pretty much the widest margin of inversion we've yet seen. Can you remind us of your view of what this means for the markets? Well, you just got it, so I hope that kind of covered it all. But it is, I think, as I said, when you've got the long rate below the short rate, it says that the bond investor believes that short rates are going to come down within a relevant period for making that kind of decision. Now, what we have actually seen is we've seen that the yield curve has inverted, increasingly so, and yet we've seen both short-term and long-term rates going up. So the inversion has remained. So far, the idea that inverted yield curves imply that we're at a peak, or we've seen the peak in short and long-term rates, isn't really working out the past few weeks. Quite on the contrary, it's been misleading, if you will. But let's see what happens if it takes out 4.25%. Let's see what the next batch of indicators do to the Fed. This next Fed meeting obviously is important for all sorts of reasons. One of them is for the quarterly meeting where they update their summary of economic projections. And I think it's a pretty a good bet that depending on the indicators above, they're going to indicate that their terminal rate isn't 5.25%. It's more like 5.5%. I don't know how crazy they want to go, but it could very well be showing 5.5%. And I'm not dismissing that as a possibility. William, do you have an opinion on liquidity trap theory to be caused by overleveraged primary dealers and too much federal debt? I don't know. I mean, the traditional. I'm just trying to see if we got any more questions here. Sure, we do. Brian said I answered his question. Thank you. I'm not sure the context you're talking about, the liquidity trap. Liquidity trap usually in the past meant that the Fed would ease pretty dramatically, and that wouldn't revive the economy. It was used to explain depressions and why easy money wouldn't get us out of a depression. I don't see that that's particularly relevant here, and I'm certainly not as aware as you seem to be about the impact of primary dealers and too much federal debt. But quite the opposite. All this debt and stimulus has actually stimulated the economy. So far, it's managed to avoid a hard landing, and so far it's given us a pain in the neck with the inflation situation. Well, I hope we don't have any pains in the neck this week or next week, but I'm sure we'll have some. But have a great week, and we'll do this again next week. Thanks for tuning in.